feeling fancy, and let's get into it. Before we jump into the nitty-gritty comparisons, let's make sure we're all on the same page. We need to understand the basics of real estate investing and stock investing. When we refer to investing in real estate, we're generally talking about purchasing physical property with the intention of generating a return. This could be through rental income or appreciation. Think about residential properties like single-family homes, duplexes, or apartment buildings. Or it could be commercial real estate like office spaces, retail stores, or industrial warehouses. Now let's switch gears and talk about stocks. When you buy a stock, you're essentially buying a small piece of ownership in a publicly traded company. The value of your stock can go up or down based on a multitude of factors: the company's performance, industry trends, economic conditions, investor sentiment, and so much more. All right, let's talk about one of the most practical aspects of investing: the cost of entry. How much money do you actually need to get started? The difference in upfront capital required between real estate and stocks is enormous. When it comes to real estate, the barrier to entry is typically quite high. The most significant cost is usually the down payment. Traditionally, lenders like to see a 20% down payment on a conventional loan to avoid private mortgage insurance, PMI. So, for a $300,000 house, that's a hefty $60,000 upfront. Now, there are options like FHA loans that allow for lower down payments, but even then, you're looking at a substantial sum. But wait, there's more. The down payment is just the beginning. You also have to factor in closing costs, which can add another 2 to 5% of the home's purchase price. Once you own the property, you might immediately face repair costs. Now, let's flip the script and look at stocks. Thanks to online brokerage platforms, you can start investing in stocks with an incredibly small amount of money. Many of these platforms offer commission-free trading, and with the advent of fractional shares, you don't even need to afford a full share of an expensive stock. You can literally start investing in the stock market with as little as $5 or $10. Offer robust pathways to wealth. All right, let's get serious for a moment and talk about risk. Both real estate and stocks come with their own unique sets of potential pitfalls. Starting with real estate, one of the most significant risks is market risk. Property values don't always go up in a straight line. Real estate is inherently illiquid, meaning it can't be quickly converted to cash. Then there are the operational risks associated with owning physical property, especially rental properties. Tenant risk is a big one. You might get tenants who don't pay rent on time or at all. There's also the risk of vacancies, periods when the property is empty and not generating any income. And let's not forget unexpected maintenance issues. Now let's turn our attention to the stock market. The most well-known risk here is volatility. Stock prices can, and do, fluctuate wildly, sometimes on a daily basis. Beyond general market volatility, there's also company-specific risk. Diversification by investing in many different stocks or through index funds can help mitigate this specific risk. Alright, let's talk about something incredibly important that often gets overlooked until you actually need it: liquidity. Liquidity refers to how quickly and easily you can convert an investment into cash without a significant loss in its value. When it comes to stocks, liquidity is generally one of their biggest strengths. For most publicly traded stocks, you can sell your shares with just a few clicks on your brokerage app or website during market hours. The transaction usually executes within seconds, and you'll know the exact price at which your shares were sold. The process of actually getting that cash into your bank account from selling stocks is also pretty straightforward. Once you sell your shares, the proceeds settle in your brokerage account, typically within 2 business days. After that, you can easily transfer the funds to your linked bank account. Now let's contrast this with real estate. Real estate is famously, or perhaps infamously, an illiquid asset. Selling a physical property is a much more complex and time-consuming process. You can't just click a button and have the cash in your account by the end of the week. There are many steps involved, and each one takes time. All these steps mean that selling a real estate asset can easily take weeks, more commonly months. So when it comes to liquidity, there's a very clear winner: stocks. Passive income. It's the dream, isn't it? Making money while you're sleeping, vacationing, or just binge-watching your favorite Netflix show. Both real estate and stocks offer avenues to generate income that isn't directly tied to the hours you work. Real estate, particularly rental properties, is often touted as a fantastic way to generate passive income. The concept is simple. You buy a property, rent it out to tenants, and the monthly rental payments, after covering all your expenses, become your profit or cash flow. However, let's be real about the passive part of real estate income. If you're managing the properties yourself, it can be anything but passive. You're the one who gets the call at 2 a.m. about a burst pipe. You're responsible for repairs, maintenance, and ensuring the property is kept in good condition. You make real estate income much more passive by hiring a good property management company. They'll handle most of the day-to-day operations. This can free up a lot of your time and make the income stream feel genuinely passive. Let's switch over to stocks. The primary way stocks generate passive income is through dividends. If you own shares in a dividend-paying company, you'll typically receive these payments quarterly directly into your brokerage account. That profit is subject to capital gains tax. All right, we've covered a ton of ground today, comparing real estate and stocks across a whole range of factors. So now, we arrive at the million-dollar question: which one should you choose? The best investment is deeply personal. The truth is, the ideal investment strategy for you depends entirely on your individual circumstances. What are your financial goals? Are you aiming for early retirement with a steady stream of income? Or are you looking for maximum long-term growth for a nest egg decades down the line? What's your risk tolerance? Can you sleep at night if your portfolio drops 20% in a month? Or does the thought of a tenant calling with a midnight emergency give you hives? How much capital do you have available to invest right now? And how much active involvement are you willing to commit? If you're someone who values tangible assets, you like the idea of having more direct control over your investment, and your primary goal is to build up a strong, consistent cash flow to cover your living expenses, then real estate might be a very attractive option. On the other hand, perhaps you're looking for simplicity and a more hands-off approach. Maybe you have limited capital to start with, or your main priority is long-term growth potential with the ability to easily access your money if needed. If you're comfortable with the inherent volatility of the stock market and can adopt a disciplined, long-term buy-and-hold strategy, then stock investing offers a very compelling path. But here's a crucial point that often gets lost in the either-or debate. You don't necessarily have to choose just one. Diversification is a cornerstone of sound investment strategy because it helps to spread out your risk. If one asset class is performing poorly, another might be doing well, helping to smooth out your overall returns. Ultimately, the goal isn't to declare an absolute winner between real estate and stocks. Both are powerful tools for building wealth. So there you have it, a comprehensive breakdown of real estate versus stocks. As we've seen, both offer incredible opportunities to grow your wealth, but they cater to different strengths, different goals, and different investor personalities. Real estate can offer that tangible asset, strong cash flow, and unique tax benefits, especially if you're willing to be more hands-on or manage a property manager. Stocks, on the other hand, provide unparalleled accessibility, liquidity, and the potential for straightforward, compounded growth with a more passive approach, particularly through diversified index funds. The most important takeaway here is that the right choice isn't about picking the universally superior asset, because such a thing doesn't exist. It's about understanding your own financial landscape, your income, your expenses, your timeline, your comfort with risk, and what you ultimately want your money to do for you. Armed with the information we've discussed today, you're in a much better position to make informed decisions that align with your personal path to financial independence. Don't be afraid to start small, continue learning, and adjust your strategy as your life and goals evolve. The journey to building wealth is a marathon, not a sprint, and the best strategy is one that you can stick with for the long haul. Whether you lean towards the tangible world of properties or the dynamic realm of the stock market, or ideally a balanced combination of both, the key is to take action. Educate yourself, make a plan, and get started. Your future self will thank you for it. And remember, every little bit you invest today is a step towards a more secure and prosperous tomorrow. Host smiling on screen. If you found this breakdown helpful, smash that like button, hit subscribe for more content just like this, and I'd love to hear from you in the comments below. Are you team real estate or team stocks? Or maybe team both? Let me know why. Thanks so much for watching, and I'll see you in the next video.